In progress. Good afternoon. We have 13 students here. Okay. Once again, please use your full name. Okay. Use your full name. Separate your first name and the last name. Please use your full name to log on Zoom. Okay. To log on our meeting. So I know who is Alex. Alex, can you use your full name?
Yes.
Okay. Yeah, please please put your last name, please.
It's Toast.
I see just Alex, so yeah, just rename and put your last name.
Okay.
Okay, yeah. In case, thank you. In case like we have two Alex, no, just one. Okay, last class we started chapter 2 and we talk about the basic future contract and forward contract. Today we continue. Last class we start to talk about margin accounts, and we talk about the IM, MM, and the variation margin, right? Also we did the example 1 to look at the price change for margin call and the price change for withdraw money, right? So we talk about this example 1. Example 1 basically is long position, right? So example 2 is short position. So let's continue. I highlight the short. Short means is sell, right? A company enters into a short future contract to sell 5,000 bushels of wheat for 250 cents. So see the units per bush. The initial margin, IM, initial margin is 3,000 and the maintenance margin is 2,000. You see, they just buy one contract, right? One contract. So this all per contract. MM maintenance margin. Question 1, what price change would lead to a margin call? Question 2, what would be the margin call price? Question 3, under what circumstance could $1,500 be withdrawn from the margin account? Okay, so question 1, to find the price change, the formula we know is initial margin minus maintenance margin per account over contract size. Initial margin here is $3,000. Okay, maintenance margin is $2,000. And the contract size, what is contract size? What is contract size?
5,000.
Yes, 5,000. So contract size is amount of assets, right? Underlying assets. So 5,000, that's correct. So can you calculate the $0.2, right? $0.2, which is what? 20 cents. Okay. I think this calculation very simple. Okay, question 2 ask you the margin call price. Margin call price. Margin call price, since this is a short. So if you take a short position, you're gonna expect a loss because margin call means you lose money, right? So the margin call price should equal future price plus the price change, right? Because you take short position, you gonna gain when the stock price going down, right? When the future price go down, you make money. If price going up, you're gonna lose money. So future price currently is 250 cents, and plus the 20 cents change, so 270 cents. If the future markets it's up to 270 cents, you're gonna receive margin call because you take a short position. Okay. And the question 3 say the case you make money. Okay. If you make money, then you're gonna withdraw money. You're gonna be able to withdraw money. So again, we need to calculate the price change first. The price change is calculated by money to be able to withdraw over number of contracts and then over contract size. So you want to withdraw 1,500, 1,500, and you just have one contract and over the contract size, 5,000. So what's the price change for question 3? Is that $0.3? So that's 30 cents. Again, you take a short position, so the price for withdrawing, you should be able to withdraw when the price going down, right? So futures price minus price change. In this case, when future price decrease, you can withdraw money. So 250 minus 30, so 220 cents. This is the price you can withdraw money. When the futures price drop, decrease and to 220 cents, you can withdraw money. Okay, that's the example 2. Okay, that's example 2. Any question? Okay, next. So this formula is for daily gain and the total profits. We're gonna use that for margin balance table. We're gonna use that. So you need to find out the daily the gain for each day, or say the total profits. So it's calculated by contract size, number of contracts, and the price change. So price change is a little bit tricky. If you take a long position, 0 and 1. So we call the price at the time 0. Basically you buy, right? And then you sell at the P1. So the price change here should be P1 minus P0. Okay. If you take a short position, again, 0 and 1. But P0 is the price you sell, and P1 is the price you buy. Okay, because you sell first and then you buy back. That's short position. And the price change gonna calculate by what? You're gonna calculate by the selling price minus P1. Okay, so most case you should sell higher and buy lower. So P0 minus P1. So in that way you can make money. Okay, so please see the difference between this price change. P1 minus P0 for long position, P0 minus P1 for short position. Understand? Okay, so it depends on it takes short position or long position. Okay, so that's very important. I hope you understand. Okay, and then let's see example 3. Example 3. Suppose that on October 24, 2016, if you see question related to time, you can draw the timeline. On October 24th, 2016, company sell 1, so this is number of contract is 1. April 2017 leaf cattle futures contracts. It close out its position, so open position and the sell. So that's short, right? This is a short. At the beginning, the sell is short position, and it's close out the position on the January 21, 2017. The future price per pound is 151.2 cents when it enters. So 151.2 cents when it enters the contract, and 148.3 cents when it close out the position, and 148.80 at the end of December. This is useless information. We actually don't need that. We don't need that. This is useless information. One contract for the delivery of 40,000 pounds of cattle. So this is what? This is contract size. That's contract size. That's contract size. The contract size is 40,000. So the question, what's the profit? Okay. The profit calculated by, remember the formula, contract size times number of contracts. So the profit equal contract size, 40,000. Number of contracts, 1. And the price change. What is the price change? Anybody can tell me what's the price change? Based on the number on the timeline, can you tell me what the price change?
It's 2.9.
2.9, how to calculate? Can you show me, can you tell me the number you use?
I did 151.2 subtract 148.3.
Yes, good, excellent. So this, which is what we talk about the case short position, right? If it's short position, we should do P0 minus P1, which is beginning the price you sell minus the price you purchase. So which is the 151, this is the price you sell, and 148.3, the price you purchase. So the difference, which is the, can you calculate the number?
It's 116,000.
It's 1,000. 160, right? Yes. Yes. This is the answer. I hope you understand. This question give you some useless information. You don't need that. And also you need to differentiate the purchase price and the selling price. And the difference, which is the price change. Okay, so that's total profit. Question. All right, next we're going to talk about the cumulative gain and the margin balance. Cumulative gain means from day 1, day 2, day 3, cumulates every day. Okay, so cumulative gain equal cumulative gain in previous day plus today's gain for cumulative gain today. Okay, margin balance calculated by like margin balance in previous day and add any variation margin. Remember, I had example on the margin variation margin last class, and plus today's gain. That's the formula. You don't need to memorize the formula, but you need to know how to use it. Okay, so next we're gonna have an example to show to use all these formulas. Okay, example 4. A retail investor takes a long position in 2 December. Okay, first is long position. So when you calculate the price change, you should do what? P1 minus P0, right? Price change would be P1 minus P0 because this is long position. And the number of contract is 2. December gold future contracts. Contract size, they give you contract size is 100 ounce. Future price is 1,020, 250 US dollar. Initial margin requirement is 6,000 contract. Here is 6,000 is per contract, and you have 2 contracts, so the initial margin is 12,000 in total. And the maintenance margin is $4,500 per contract. So as long as the margin balance below maintenance margin, then you're gonna receive margin call, right? And then you need to bring back the margin balance to initial margin, right, level. So that's the information given. And the question would be, you need to complete the table to figure out the margin balance and the profits for each day. So this is the possible outcome. And this example from book, page 30. The first column shows day. So day 1, day 2, day 3 until day 16. You see have 2 day 1. This shows day, you can put it 0. Doesn't matter, which means the beginning price, the purchase price. You take a long position, right? So this is the price you purchase. But at the beginning of day 1, this is the price you purchase. At the end of the day 1, the price become 1,241. So for day 1, the daily gain calculated by, anybody can tell me how to get this number? Negative 1,800. Remember, we do calculate the for long position. We calculate the price change. We calculate the profit. This is talk about daily gain. Daily gain. You should calculate by number of contract times contract size times price change. And the price change calculated by P1 minus P0. Anybody can tell me how to get the 1,800 negative?
You have a long position, so you would have subtracted the settle
Yeah.
price from the trade price and then multiplied it by 200 because that's the number of ounces in the contracts.
Yes, good. Time two because they have two contracts, and the contract size is what? 100. So time 100. Please double check. This is negative 1,800. Good. Thank you. Yes, that's good. So you need to do settle price minus trade price, which is ending price minus beginning price, right? Ending price minus beginning price. Ending price P1, beginning price P0. Okay. So that's for daily gain. Cumulative gain, the next column, cumulative gain, because this is the first day. So cumulative gain, same as the daily gain, okay? Because this is day one. They don't have a previous gain, right? And the margin balance at the beginning of day one, which is day 0, the margin balance is initial margin, okay? This is initial margin. So margin balance start from initial margin. So initial margin and at the end of day one, margin balance become what? Become margin balance calculated by previous margin balance is 12,000 plus any variation margin. So the last column here is called a margin call, or you can put the variation margin. Okay, same thing. We don't have variation margin, right? So plus 0, and then plus today's gain. Today's gain from column daily gain. And because it's negative gain, so we should put a negative 1,800. So that's the margin balance for day one. Can you calculate that? Is that 10,200? Is that 10,200?
Yes.
Okay, good. So that's 10,200. And this amount, after we get the margin balance, we need to compare with the maintenance margin. Maintenance margin in this case is 9,000 because two contracts, so 9,000. As long as it's above 9,000, then you are fine. You are fine. You don't need to. You won't receive margin call. Okay. So if you get any balance above 9,000, then you can go to next day. Next day, day two. Day two, the settle price, which is ending price for day two, is 1,238.3. And what's beginning price for day two? Beginning price for day two, which is end price for day one. Okay. So when you do the price change, day two, you should do what? The ending price for day two is 1,238.3 minus the beginning price for day two, which is the ending price for day one, is 1,241. And same thing, time number of contract, time contract size. Okay, so you will get what? Daily gain. This is daily gain for day two. And the same thing for other day, which is the price for the day is ending price, and the beginning price, which is the ending price in previous day. Okay, I hope you understand that. And the last one, you see the day 16. Day 16, they have a trade price, which is they buy back. This is the long position, so they sell it, sell this contract. So this is the selling price, and this is the ending price. And you're gonna use this and the price in at the end of day 15 to calculate the daily gain in 16. Okay, so in your assignment, you need to do you need to calculate the gain for each day until the end, until the last day. Okay, come back to the day 2. Day 2 cumulative gain should calculate by cumulative gain in previous day, which is negative 1,800, plus the today's gain, because both negative. So negative, which is add together, negative 2,340. That's the cumulative gain. Okay, I hope you be able to do that. And the margin balance, again, margin balance calculated by the previous day margin balance, plus variation margin. You didn't receive any margin call in day 1, right? So it's 0. And plus today's gain. Today's gain, not a cumulative gain, okay? Today's gain is what? Negative 540. Negative 540. So what's the margin balance? Margin balance would be 9,660. You see this amount is still above 9,000, right? So you won't be able to receive margin call. And you do the same thing for for days 2, 3, day 4, day 5, day 6, day 7. Until day 7, you see day 7, you got the margin balance is 7,980. This amount below 9,000, right? Below 9,000. So you're gonna receive a margin call. And you need to add the variation margin. And how to calculate this variation margin? Remember, last class I told you how to do it, right? Initial margin minus margin balance. That's variation margin. Initial margin is the 12,000. And the margin balance is 7,980. So the variation margin you should provide is 4,020. You need to provide this variation margin to the account so that bring your balance to initial margin. And the last thing I would like to talk about is after you receive the margin call, and the next day, if you calculate the margin balance, you should do what? So for this case, margin balance should calculate the previous day margin balance is 7,980, right? Margin balance. I'm talking about how to calculate margin balance next day. The previous day margin balance 7,980 plus variation margin. We have a variation margin in day 7, right? So this is day 8 plus 4,020 and the plus day 8 gain. Day 8, you have a daily gain is 180. So that's all for margin balance in day 8. Okay, don't forget the variation margin because in previous day you received the margin call. So actually the total, the margin balance and the variation margin, this is what? Initial margin, right? So 12,000. 12,000 plus 180, so which is 12,180. This is the margin balance for the day you receive margin call. This is very important. So that's, I would like to talk about this. Any question? No question. I'm gonna ask a student to tell me how you get the, I'm gonna ask a student just a simple question, okay? How to get this number? Anybody can answer me?
Which number is it, Professor?
Did you see my the red color? Let me erase other notes so you can see. my question. Can you see my note? My handwriting is day 7, daily gain. Negative 1,260. Anybody can tell me how to get this number?
You would have lost $6.30 from the previous day's settle price.
Mm-hmm.
So negative $6.30 times 200 ounces of gold in contracts would be negative 1260.
Yeah, good, very good. Yes, very good. And how to get this number? Next. Anybody can answer me?
You use the cumulative gain, previous cumulative gain, and plus the daily gain.
So what number you use?
Negative 2,760 minus 1,260.
Yes, excellent. Yes. So these two numbers added together, which is the cumulative gain in day 7. Yes, good. And how to get this number? How to get the 7,000? 7,980.
You would subtract your daily gain, or in this case, you would subtract your daily loss from your previous margin balance.
Yes, excellent. So which is 9,000, the previous day margin balance, because the day 6 we don't have a margin call, right? We don't have variation margin, so that's 0. So we just consider margin balance in previous day and add the daily gain in day 7, but the day it's basically is loss, not a gain, right? So 9,240 minus 1,260. So the answer is 7,980. So because this number below the maintenance margin, so you're gonna receive margin call, and you need to have a margin balance, variation margin. Okay. Yeah, I believe most students know how to do this type of question and do the margin balance for each day. We're gonna have a question in the assignment, the question 3. You need to calculate the margin balance for each day and complete the whole table, which is you need to find out the daily gain, cumulative gain, margin balance, and the variation margin, if any, okay, if any. Any question before we?
Professor?
Yes.
I have a question about day 16.
Okay.
So if the if the trade price is lower than the settle price for day 8, then how come the margin balance is higher by about 3,000?
Give me 1 second. You said the day 8, right?
Yes, from day 8 to day 16. I was just wondering how the margin balance increased when the cumulative gains decreased.
Can you say it again? Sorry.
Yes. So
You
for
asked the margin balance, right?
yes, for day 16, the margin balance is a lot higher, but the trade price is a lot lower than the settle price was from day 8 to day 16.
No. We skipped a lot of information. So.
Oh, okay.
Yeah, we don't have a day 15. So this is from the book. You can see all the complete information. So you cannot compare this. Yeah.
Okay, I'm sorry about that. Thank you.
Yeah, that's fine. Yeah, sure. So this is just example. We just showed a few days for the final day. You need to check the price in the book, and you're gonna see do exactly the same thing as we did in class. Yeah, sure. I think your question valid, but if you get the price in day 15, you're gonna see why. Okay. If you still have a question, you can let me know. Good. No more question, right? Next, this talk about the credit risk. Margin account have the effect of reducing risk of one party regarding the deal and backing out, and also ensure the funds are available to pay traders when they make a profit, and reducing the systematic risk due to collapse of futures markets. So this is talk about the margin account associated with the credit risk. We basically finished chapter 2. Okay, we finished chapter 2, and some information in the book we didn't mention, but that's kind of like background information you can read from the book. And remember your assignment, okay? And I would like to check assignment with you together. So assignment due first. You need to know assignment due. When is due day? So it's due the end of the week, right? Assignment due the end of week, which is the January 31st. Okay, so we don't have a class on Fridays. I think you have a lot of time to do. Okay, no excuse. The assignment will not be available, so do not ask me to open it again. So do it as soon as possible. Do not wait until the last minute. Okay. So no class on Fridays. You have time. Please make the best use of the time and to do the assignment. Before we talk about that, I would like to mention the groups. Some students probably joined this class recently, so you probably don't know that. So group, you need to sign up a group, okay? Sign up in a group to do the group project, which is the case. Each group up to 4 students. Okay, each group up to 4 students, which is the 4 student, which is the group is full. Okay, you cannot join, but you can join other group. Okay, join other group. Just 1 student in the group. Okay, not 2. And you should be able to see who are in your group and the email contact information about each student in the group, and you need to get connect each other and to make a plan, okay, for the group project. Any question about the group project? Okay, about the homework. Homework. Complete the assignment before the end of Sunday. Provide the details for the answers. No points are credited for the work with owning a number. Okay, so you need to provide a detailed procedure. I'm gonna post the slide with the solution I went through in class. So even you missed the class or missed the notes, you still can check the slides or watch the video. Okay, the assignments. Take home assignment number 1, chapter 2. You're gonna have 3 questions. Question 1 asks you long position. I highlight long position. So you calculate the price change, margin call price, and the price you're gonna withdraw money. And the question 2 is talk about the short position. We went through example 2 similar to this, right? And the question 3, it's margin balance question. So retail take a long position. You see, long position. So that's one thing you need to know. And the 3 contracts. Contract size, future price, initial margin, maintenance margin. So you have 3 contracts. The total maintenance margin is $15,000. So as long as margin balance below $15,000, you're gonna provide the variation margin, right? You're gonna receive a margin call. So question, what are the daily gain, loss, cumulative gain or loss, margin balance, and the variation margin from day 1 to day 16? Here I provide all the settle price for each day. So what you need to do is I didn't put a 1 for the beginning price. The beginning price of day 1, beginning price of day 1, which is the purchase price, 1,250. That's the price you buy because you take a long position. And at the end of day 1, you have a price 1,241. So the gain, daily gain would be what? Ending price minus beginning price, right? You know how to do it. So that's for daily gain. And the cumulative gain, because that the first day, so the first day you don't need, you don't have a previous day, so just the same gain at the daily gain. Margin balance, the previous margin balance, which is initial margin, right? 8,000, 18,000, that's initial margin. Okay, the last column is variation margin. Variation margin not always positive. It depends, right? Depends margin balance. If margin balance greater than $15,000, variation margin would be 0. You can leave it blank. Or if margin balance below $15,000, then you're gonna provide the variation margin. You need to calculate the variation margin by initial margin minus margin balance, right? Okay, so and the last day I would like to talk about this. The last day you have a price, which is the trade price. The trade price basically is the selling. You sell the contract. You sell the contract 120 or 1,226.9, and the previous day ending price is 1,223. So the difference between this is what? It's positive, right? It's 3.9 price change and times the contract size and the times number of contracts. That's for daily gain, right? And they do the same thing for cumulative gain, margin balance. So any question? I think the tricky part is the variation margin. So make sure variation margin only greater than 0 when margin balance below $15,000. Okay, so you can just feed the number, but I prefer you provide the couple of the previous day, a couple of days, like how you calculate daily gain. For example, you just provide day 2, day 3, so that I know how you calculate others. You don't need to provide every day's calculation, but I prefer you give me 1 day or 2 days calculation for daily gain, cumulative gain, and margin balance, and if they the variation margin. Is that okay? Understand my requirement?
Yes, understood. Understood.
Okay, good. So you don't need to provide everyday calculation, but I prefer you provide just a few days, like 2 days or 1 day. That's fine. But just the numbers, I still need want you to provide the detailed procedure. Okay. That's all for assignment, and for this week. The slides, I'm gonna post the slides with the solution, and I have a video for 3 classes on the Zoom videos, so you can watch the video again if you missed any part and homework. So the bottom part, it shows the review for the first 2 weeks. Here is the list of course component that you have complete. You should read the book. You should review the slides and the Zoom video. You should complete homework number 1. Submit it to the Dropbox. You can do your work in the Word file and upload the Word file, or you can do handwriting and take a picture and upload the picture to Dropbox. So either fine, okay? But do it as soon as possible and complete before the end of the Sunday. That's all I would like to talk about for chapter 2. So next week, we're gonna start chapter 3.
Thank you very much, Professor. Have a great weekend.
Yeah, you too. Okay,
Thank you.
that's all. Thank you. So no question.
you.
Anytime you can email me for any question. Okay, that's all. Have a good day. Bye.
Thank you.
Bye.